Hello students, my name is Jesse George, your professional accounting teacher. Before you continue with this video, please try to subscribe to my YouTube channel, the Georgian Theory Concepts. Thank you. Alright, let's get started. Please, I want you to pause this video and read through this question. Thank you for doing that. Okay. In this video, we are going to look at the concept of accounting for depreciation. Accounting for depreciation. A company depreciates its fleets of motor vehicles at the rate of 25% using the reducing balance method. From the information given below, you are required to draw up the following accounts for the year ended 31st December 2021 and 2022. The motor vehicles account, the accumulated depreciation account, the motor vehicle disposal account, a statement of financial position as at December 31st, 2021 and 2022. Then we have the information, the transactions has been given. Okay. All right. Now let's get started. So the first thing is to draw up the accounts as follows. All right. So you draw up the accounts, motor van, accumulated depreciation, then asset disposal account, and the statement of financial position. So let's start with the motor van account. Let's look at the transaction. The first transaction says that on January 1st, 2021, so you have 2021, purchase 6 cars for 50 million each. 6 cars for 50 million. That's January 1st. Since the name of the supplier is not mentioned, all right, we assume it was bought in cash. Money has been paid, so we have 6 multiplied by 50 million, okay, and that gives 300 million. Okay, don't forget this has been limited to 0. Then on that same year, another car was bought. 2 trucks were bought. 2 trucks, 2 motor van was bought. That is September 1st. Also have bank, and it was bought for 500 million. So we have 500 million. Okay, class. Then there was nothing again for that year, so you need to close up this account. How do you close up the account? So account is normally closed by the end of the year, which is December 31st. So we have balance carried down. So when you add these two, we have 800,000. When you add this, we have 800,000. Okay, 800,000. All right. So then, by the following year, 2022. So we have by January 1st. Our balance brought down is 800,000. All right, 800,000. Then what happened in 2022? In 2022, by November, a particular asset was sold. In 2022, it was sold. So you have to remove the cost of the asset from the motor vehicles account. The cost, don't forget. The cost of the asset, it was sold in November 1st. You remove the cost to asset disposal account. Asset disposal accounts. So the cost, that's 2 cars that was bought in January 1. The cost of the cars in January 1, the cost is 50 million. So multiply by 2, that's 100. So that's 2 cars multiplied by 50 million, and that gives 100 million. Okay, don't forget this is Lee that has been limited. Lee. All right, 100 million. Then what happened again? By December, we purchased another truck. So another truck was purchased in December 1. So that's bank. Another truck was purchased for 200 million. All right, there was no transaction again. So what we need to do by December 31st, we need to balance our accounts. Balance the accounts. So when you balance the accounts, say balance carried down. So this is 1 million. So that's automatically 1 billion. So this is 900. All right, that's the cost of our motor vehicle. Balance, that's 1 million. All right, okay. Now the motor vehicle account has been done. So by 2023, we'll be having a balance by January 1st. In January 1st, we'll be having a balance brought down of 900 million. All right, now let's come to the depreciation aspects. So we need to be very careful here. Don't forget, depreciation is always calculated by, in 2021, by December of every year 31st, using reducing balance method. Okay. So if you look at the assets, we have two assets. So we are going to prepare a schedule for that. So which is a calculation of depreciation. Okay, using reducing balance method. Okay, right? That's our working notes. All right. So we are going to have something like this: cost. Okay. Then don't forget, because we are told that a particular asset was sold. So we have three categories of assets there. All right, we have three categories of assets. The 100,000 that was sold. Okay, if you look at this, we have those ones that were bought. Out of this, 100 million has been sold. All right, out of this 300, 100 million has been sold. So we have another 200 million for that. Okay. Then there was another one that was bought late in the year by September. So you need to separate them. So this one was sold. I will tell you why we are separating. You know, this and this, that is amounts to 300,000 that was bought in January, but we need to separate them. I have a reason for that. Okay. Now this was in September. Then another one was bought. Another asset was bought when? In 2022, and that is 200 million. That's 200 million, so we need to put it here, 200 million. And don't forget, this Lee, you have limited them, Lee. Okay, Lee. All right, class. Now, using reducing balance method, our 2021 depreciation. The first for this is 25%. Okay, and how much is that? 25% of this is 25,000. Okay, 25% of this is 50,000 class. All right. Now this asset was bought in September, 1st of September. So if you count September to December, that is September, October, November, December. That's 4 months. So we need to bring it down. This September, 25% multiply by 4 all over 12. So when you multiply this, then multiply by the cost of this asset. Don't forget, and that will give you 4166. Then approximately 7. Okay, we have limited into thousands. Okay, now this asset was not in existence as at this year, so there is no depreciation. For it. Okay, then what's our net book value? All right, this will give us 750. Then this will give us 150,000. Then when you subtract this, it will give you 45,833. And of course, this came in 2022. So this is 2022. All right, this is 2022, and that's 200,000. Don't forget, in 2022, our depreciation for 2022 depreciation goes thus. We are going to calculate on reducing balance, so it must be on this balance. If this straight line, it would have been just once. Okay, so we have on this, we have a 25% on this will give us. And don't forget, this asset, the reason for separation is that it was sold when? In November 1st. So it means it has been existing from January. It existed from January 2022 to October. From January to October. Don't forget, this existed from January to October. And that is 10 months. So you just multiply by 10 all over 12. So when you multiply, it's going to give you 15,6,250. 16,250, okay, on the reducing balance. All right, okay, then on reducing balance method, all right, class. Now for this, you calculate full depreciation, which is 25% on the balance, okay, and that will give you 37. That's depreciation 25%, so it will give you 37,500. Of course, you also calculate full depreciation for this, which is what? 114,583. Okay, then for this, the asset came in December. So we have depreciation. The asset came in December. So if it came in December, just 1 month all over 12 times 1 month all over 12, and to give you, multiply by this, we give you 1042. So just multiply 200,000, multiply by 25% times 1 all over 12. 200,000 times 25% times 1 all over 12. So because it came in just 1 month in December from the question, it came in December. Okay. All right. Now, so this is what we need. We now add this depreciation. We add this plus this plus this. Okay. Then for this, for the year, we add this, we add this, we add this for 2012. So let us add these three together. So when you add, we have 25,000 plus 50,000 plus 41,667, and that is 11,6667. Okay, and that goes to P and L. So our working notes 1. So these are working notes, or better still, we have 25,000. You can just put plus 50,000 plus 41,667. So these two will give us to P and L. That's 11,667. So which goes to P and L for that year. 11,667 goes to P and L. Then by 2001 December, our balance, accumulated depreciation balance carried down is 11,667. Okay, 11,667. Then by 2022 January 1st, we have our balance brought forward of 11,667. Okay, now the depreciation for this year, we need to add this up. So when you add this up, what do you have? So you have 168. So for this, we need to show that we have 5,625 plus 3,7500 plus 111 114,583 plus 1042. So when you add this, it's going to give you 168750. All right. Now, don't forget, we sold an asset in November 2022. So you are going to calculate all the cumulative from the date of purchase, to the date of disposal, from the date of purchase, and is in the working notes, which is this. This is the date from the date of purchase. Just add these two together to the date of disposal. From the date of purchase to the, so it will go to disposal account, and that is 2022. An asset was sold in November 1st. So it will go to disposal accounts. All right. How much? When you add these two together, it's going to give you it's going to give you 40625. Just add the depreciation from the date of purchase to the date of disposal, which is this figure. So this workings has given you okay. If you look at the workings very well, it has given you. All right. So then this goes to disposal account. So I'm coming to the disposal account. Then you're going to have balance carried down. Then let's take our balance. So you add this plus the opening balance plus the opening balance 1166667. That's 285417. 285417. Then minus 40625, and that gives 244792. All right. Now, for the disposal of assets, if you go back to your motor vehicle, this is asset disposal, which was sold in the cost, which was sold in 2022. Then you credit motor vehicles account, then you debit this account, that is asset disposal account, with the cost of the asset, which is motor. Don't forget, it was sold in 2022, November 1st. We have motor vehicle. The cost is 100,000. That's 100 million. Okay. Then it was sold for, that's the proceeds on disposal. That is your bank. All right. You debit bank and credit this with 90 million. All right. Then the accumulated depreciation on the disposal, which is this, will now be posted and say accumulated depreciation, which is 40625. Okay. Then you add both sides. Of course, this side is more than, that's 13625. Then here we have 13625, and this gives a profit on disposal. This is profit on disposal of assets, and it goes to P and L. Okay, for that year. So we are going to have 30625. That's profit on disposal. All right. Then lastly, you prepare the statement of financial position. So extra, that's statement of financial position. Extracts will be prepared. So for 2001, you have under non-current assets, you are going to have your motor vehicle. What was the balance? The balance we had was 800,000. 800,000. That's balance as at December 2001. Okay, which is 800,000. So we have 800,000 minus, that's less depreciation. Accumulated depreciation as at December is 116667. So our net book value or carrying value. So when you less this, what do you have? When you less this, you have 800. Don't forget, this is Lee. We are working in thousands. Lee 800 minus 116667. So that is 68333. Lee. It's just an extract. Then for 2002, you do the same thing. Motor vehicle, the balance as at that is 900. Is 900. The balance in the motor vehicles account, the balance is 900. So you have 900,000 less depreciation. So what's the depreciation value? Accumulated depreciation as at that time is 2244792. So when you less this, so we have 900,000 minus 244792. Okay, and that is 66. The net book value will be 655208. Okay, so if you understand this, please do share with your friends. You can rewatch the video. Thanks for watching. I remain your professional teacher, accounting teacher. Bye for now.